Okay. So this is the question you have, right, about this voyage problem, right?
Yes.
Okay. So yeah, maybe you are not the only one who are challenged by this question. So I think in general, students are doing not as well in the quiz two. So
Yeah.
I think the average in this one is so far, I think it's about 71% for quiz three. The other two quizzes, quiz two is like 91% on average. So this one, students are not doing as well as the previous two quizzes. So yeah, I'm going to talk about this trading voyage question, okay? So do you have any particular concerns before I talk anything? Do you want to ask anything first?
No, I would just like to hear what you have to say about it.
Okay, sure. Yeah, so so basically you were given a timeline information. Okay, are you able to see the timeline here?
Yes.
Okay. So this timeline tells us about the business activities, right? So basically, just from this picture, okay, the company purchased three ship, right? So at Amsterdam, Batavia, Holiday, right?
Yes.
So and they make each ship is making different voyage, right? Different trips over the time.
Yeah.
So that's basically the idea. And about this picture, so the first ship made only one trip, okay. And then in the year two, this ship is destroyed, right? It's sunk in the ocean. The second one made three trips, okay.
Yes.
And the last one made two trips, okay. So in total, there are 1, 2, 3, 4, 5, 6 successful trips, right?
Yes.
Yeah. And at the end of the fourth year, they only have two ships left, right? So they sold the two ship, right?
Yeah.
So that's the basic information here, okay? Okay, let's take a look at other facts. Okay, here. So here's more information we know. Investors provided 20 million in finance to start up the company. Okay, so that's how they get the initial money from the investors. The amount is 20 million. Each ship cost 5 million. Okay, and on average can complete 10 voyage, right?
Yeah.
So unless it's sunk by storms, hazard, or perils. So this one tells me a little bit about the depreciation method, right? So you know the cost, right? You know the number of the trips, right? So basically, we could do the depreciations based on the number of the trips, right?
Yeah.
So over the useful life of the ship, you have 10 trips, and for each trip, it's going to be $500,000, right? So 5 divided by 10, right? 5 divided by 10. So for each trip, okay, the depreciation should be $500,000. Does that make sense?
Yeah.
Okay, so operating costs for each ship, for each trip, are $1 million to pay for the crew's wages and to stock the ship with inventories and supplies. The company must pay for this cost in advance because the goods and the crew may perish at sea. Okay, so the idea is before the start of any trip, okay, this operating cost already incurred. You had to pay this in cash, right?
Yeah.
Yeah. A successful voyage return usually within a year. Right? It could take multiple years, depending on the weather condition. With goods that can be sold for 5 million. So when the ship came back, arrived, they could have a sales of 5 million. Okay. For accrual reporting, the company records the cost of product shipped out and traded in exchange for products from Asia when Asia products are sold at home port. Okay. So this tells me the company record the cost of products shipped out and traded in exchange for products from Asia when Asian products are sold at home port. Okay, so basically, when they get these Asian products and they came back, they sell this product. That's the time they recognize the sales, right? And then this is the time they recognize the expenses. Okay, remember?
Yeah.
Operating costs, right?
Yeah.
And you have been paid at the beginning of the trip. Okay, so this is the time they recognize the expenses. The cash flow happened first, but the expenses is recognized here. Okay, so before the start of the trip, okay, at the beginning of the trip, you pay the cash, but you do not recognize expenses until when the ship come back and at the home port. Okay. Similarly, the company record the cost of supplies and wages as well as depreciations when ship returns home. When the ship returns home.
Yeah.
When the company receives information about the sinking of one of its ships, the company writes off the recorded value of that boat and expense any inventories, prepaid wages, and prepaid supplies on the book. So basically, the minute you get the news, the boat is sunk, right? Then you have to write off everything, right, related to the boat because that boat disappeared, right? So anything related to the boat has to be cleared from your book, right? Last information is, in addition, assume that remaining ship sold for $3.5 million each just before the end of the year 4. So they sold these two boats together for $7 million. Each is $3 million. Okay, and the company will be closed at the end of year 4. Okay, so that's the information. Do you have any questions about all this information?
No, that's clear.
That's clear. Awesome.
Yeah.
So now, what else do we have? We have this thing.
I have a question.
Yeah.
Could you zoom in a bit? Is it possible for you to zoom in a bit?
Zoom in. Okay. Do you know how can I zoom in? I'm so sorry.
No. I thought because on your computer, I thought you could just maybe zoom in a bit to see the words.
Okay. Just give me a second. Let me try. Okay. How should I zoom in? Okay. Just give me 1 second.
Yeah.
Okay. So let me see. Now you are still seeing the full screen, right?
Yeah, I can still see it.
Okay.
It's just the words are very small.
Okay. Okay. I don't know how to zoom it in.
It's okay if you can't.
Yeah, unless you know, like, is there a shortcut I can zoom this in? Because right now I'm sharing the screen, right?
It's more so just using your mouse. You could. It depends on what you're using. If you're using a mouse or a trackpad. Are you using a laptop?
I'm using a mouse, so I'm using an Apple.
Oh,
so
it's fine. It's okay.
Okay, but in the future, I have to be careful, right? Because if you're not able to see very well, that's not very nice.
Yeah, but
I'm just thinking. Okay, just give me 1 second.
Okay.
Okay, so can you just give me 1 second? I'm going to ask Google. Okay.
Yeah, of course.
Okay. How to zoom? Maybe maybe I should not use this Zoom. How to make a screen bigger in Zoom meeting, because I don't want to confuse display option, sharing speaker view. Zoom in out of Teams. That's team. Zoom room display option. Speaker. Okay, so
there, I feel like there might be confusion because
yeah,
this Zoom and you're
yeah,
asking
when you use Zoom, right? So how do you what's the word would be? How to
magnify.
magnify? Yeah, screen sharing. Oh yeah, do they have how to share a screen? How to share your screen? How to share your screen in a Zoom meeting? See, they didn't see anything like that. Screen sharing.
I think also because of how the software, the Pearson software is.
Zoom recording. Okay. Okay, so we have talked about this timeline. We have talked about this important information here. Okay.
Yeah.
Hopefully this one is a little bit bigger. So this is the same. So, basically they give you informations. This is the cash flow statement, right? For the first 2 years. And your job is to complete for the remaining 2 years and also the total. Here is for the statement of income and the return earnings. And here is the balance sheet. So they provided the information for the first 2 years, and they want you to finish year 3 and year 4. Okay. Okay, so I'm going to walk through with you on this. Okay.
Okay.
Yeah. So let's take a look at what happened in year 1. Okay, just to help you understand how these numbers put together. For year 1, this is the year 1, right? Okay, you can see, okay, they start 3 trips, 1, 2, 3, right? So within year 1, they start 3 trips, right?
Yeah.
They finished 1, okay, only Amsterdam came back, right? Within year 1, okay? So the inflows, okay, the inflows from the sales of good, right? So you sell the goods for $5 million, right? Here. Okay. What is the operating cost? Cash, right? 1, 2, 3. Each cost 1 million, right?
Yeah.
So that's 3 million, right?
Okay.
That's just 3 million. So your cash flow from operations is $2 million, right?
Yeah.
Okay, $2 million. You purchase the boat, okay? You purchase the boat for $5 million each, right?
Yeah.
And you purchase the 3, right? That's why you use the $15 million for investing activity. Okay?
Yeah.
And for financing activity, you received 20 million from the investor. Okay?
Yeah.
So that's why 5 minus 2, that's 2 from operating. And then from investing, you use the 15. From financing, you received 20. The net cash flow for the year is 7 million.
Yeah.
At the beginning of the year, you have nothing. You are a new company. So the cash at the end of the year is 7 million, right? Okay. So for the year 2, right? For year 2, okay, they start this trip. They start 2 trips, right?
Yeah.
D and E. And then they learned in the middle of the year 2, D sunk, right? D sunk. So what happened is, how many trip returned, right? One boat returned, B returned, and so that's where the sales from. So you have a sales, only one boat returned. You have 5 million sales, okay, and you start 2 new trips, right? You paid $2 million, okay, and then cash flow from operation is 5 minus 2 is 3. There's no new investment activity and financing activity, both 0. So it's 3. So now beginning balance is 7. Your ending balance is 10, right? Okay. Okay, now let's take a look at year 3. Okay, year 3. This is your part, right? Year 3, in this shaded area, right? You can see that 2 boats came back, right? E and C, right? So the sales would be 5 times 2, right? So it's 10 million here. Can you see 10 million?
Yes.
Okay, so that's 10 million here. And operating, what is the operating cost? Okay, what is operating cost? So you start, you
started 1 voyage F.
Yeah, so you start 1 or 2 in year 3. You start 1 here,
1.
right? So F, so in year 3, you only start the trip F, right? That's why it's 1 million, the operating cost.
Yeah.
So the cash flow from operations is 9 million for the year. Okay. So no new investing or financing. So net cash for the year is 9. Beginning balance is 10. Okay. So your ending balance for cash is 19.
Okay. Yeah.
Yeah. Okay. Move to the year 4. Okay. Year 4. You have 2 trips finished, right? 1, 2. So again, your sales will be 5 times 2, right? 10 million. You start 1 trip, right? The G is what you start.
Yeah.
You have $1 million operating cash, right?
Yeah.
So it's 9. And for investing activity, you sell your boats, right? At the end of year 4, and each boat you sold it for 3.5 million. For the 2 boats, you get money, you get cash 7 million, right?
Yeah.
So here, cash flow from investing activity is 7, right? So 9 plus 7, that's 16, right? That's
what
16.
happens to the other ships? What happens to the other ships?
Which one?
Like the, sorry. Okay, so you're selling off the one that went on the voyage C. Sorry, the one that went on the voyage G and F.
Yeah.
And those are still the same ships that went on the other ones before, right?
Yeah.
So ultimately, okay, yeah, never mind. It's still 3 ships.
Yeah. The other one sunk, right?
Yeah.
Yeah. So yeah. So and then for year 4, $9 million for cash flow from operation, 7 million from investing activity. So in total, the net flow for the year is 16 million. And the cash at the beginning is 19. So your ending balance is 35 million. Okay. So then the total column, this column is easy, right? You just add all these columns together. So there are total 6 successful trips. 1, 2, 3, 4, 5, 6, right?
Yeah.
So 5 times 6, so that's your 30 million sales, right?
Yeah.
And there are 7 trips, right? 1, 2, 3, 4, 5, 6, 7, including this unsuccessful trip, right? Yeah. You still pay for it, right? So 7 times $1 million each. So you have 7 million, right? So your cash flow from operations is 23 million, right?
Yeah.
your cash flow from investing activities. So the purchase cost is 15 million. You sold it for 7 million. So the net is 8 million, right? That's the cost. And the cash flow from financing activities 20 million. Okay.
Yeah.
So the net cash flow is so you have 23 minus 8, 15 plus 20, that's 35. And your beginning, the very beginning, year 1, 0. So at the very end of year 4, you should have 35 million. Does that make sense?
Yeah.
Yeah, good. So we are comfortable with this cash flow statement then?
Yes.
Okay. Now let's talk about the statement of income and the return earnings. Okay. In the first year, the revenue is 5 million from the trip A, right?
Yeah.
Operating expenses, remember you recognize the operating expenses when the trip arrived, right? When the when the boat comes back at home port, right? So that's this one, A, you recognized for 1 million, right? 1 million for each boat, each trip. Depreciation, you recognized when the trip is finished, right? How many finished? Here, only this one. And each trip costs you 500,000 depreciation.
Yeah.
Because you can run boat for 10 trips, right? So that's the depreciation. Okay. And write off of the sunken trip. In year 1, right? By the end of year 1, no bad news, right? No bad news.
Yeah.
So 0, write off, no write off, right? There's no bad news at the end of year 1.
Yeah.
So your net income is 5 minus 1 minus 0.5. That's 3.5. Okay. Beginning return earnings is 0. Your ending return earnings is 3.5 million. Okay. Now year 2, right? Here's year 2. So year 2, we have trip B came back, right? Trip B ended, right? So that's where the 5 million and the 1.0.5, right? These numbers related to the return of the boat, Batavia, right? And then you write off the sunken trip. So this trip, at the end of year 2, you already know, right? This boat is destroyed, right? So you should not keep the value on your financial statement, right? So how much you need to write it off, right? How much you need to write it off? What is the loss of this ship? That's a good question, right?
Yeah. So are you going to have the depreciation from it?
So basically, the book value, the cost is 5 million, right? For each boat, right? And for the year, you recognize depreciation. The cumulative depreciation is 0.5, right?
Yeah.
Did you get any money from it? No, right? It just went to ocean. You get nothing, right? So you lose 4.5.
Yeah.
That's your loss, right? So so here you write off the sunken ship for 4.5 million, right?
Yeah.
This is your loss, right? Your loss. And also the prepaid expenses. So this ship, you already paid for the $1 million here, right? Before the start. Now it will never come back. You have to write it off that, right? So that's another loss, 1.0 million, right? So your net loss income here, 5 minus 1 minus, this is 5 minus 1. So your net loss is $2 million for the year 2, right?
Okay.
Yeah. Does that make sense?
Yes and
5
no.
minus 1 minus 0.5 minus 4.5 minus 1 equals minus 2.
Yeah, I was looking at the 1 million.
Here?
Because Yeah, so you're writing off the prepaid expense, which is the expense for the ship to go on its voyage.
Yeah.
But then there's also the operating expense there.
Yeah.
So
so therefore different things, right? So the operating expenses is from B, right? So when B come back, you have the sales of 5 million and you recognize the 1 million you paid here. That's the operating expense. It's related to this trip.
okay.
Yeah. So when you made the sales from the trip B, right? The 5 million.
Yeah.
That's the time even though you pay the cash, at the beginning, but you only recognize, because of accrual reporting, you only recognize it when you made the sales, right?
Mm-hmm.
So that's this 1 million, 1.0 million here. Okay.
Okay.
Yeah. The other one, this 1.0 million, is about this trip, the trip D, right?
Mm-hmm.
You paid it here, you prepaid, right? You prepaid 1 million here.
Yeah, but it
But
didn't come.
this boat will never come back. You will
Right.
never recognize the expenses, right?
Mm-hmm.
Because you won't have any sales, right?
Mm-hmm.
So you never recognize the expenses, so you have to write it off, the prepaid. Yeah.
Mm-hmm.
But don't confuse the two $1.0 million. The first one is related to trip B. The second one is related to trip D.
Yeah.
Yeah.
Mm-hmm.
So the opening return earnings is 3.5. So the ending is 1.5. Okay.
Yeah.
Okay. Now let's move on to year 3. So for year 3, I have 2 successful returns, right? E and C.
Mm-hmm.
Okay. So my sales should be 10 million, right?
Yeah. Mm-hmm.
And I'm gonna recognize the prepaid, right?
Yeah.
The
2
2
million.
million. Yeah.
Yeah.
The depreciation, each boat is 500,000. 2 boats together is 1 million.
Yeah.
Yeah. And there's no bad news, right? You see.
Mm-hmm.
Yeah. So 10 minus 2 minus 1. So this time they have income of 7 million. The beginning return earning is 1.5. The ending is 8.5.
Mm-hmm.
Okay. So moving to year 4. At year 4, again, you have 2 successful returns, right? In the G and F. So you have 10 million sales minus 2 million operating cost minus 1 million depreciation, right? Okay. And what else? You sold these 2 boats, right? You sold these 2 boats. Okay.
So you get 7 million.
Yeah, you sold it for 7 million, right?
Mm-hmm.
But what's the value? What's the book value, right? What is the book value? So for 2 boats, right? Each boat is the cost. The cost for each boat is 5. So for the 2 boats, the cost is 10 million, right?
Mm-hmm.
Okay. How many trips they make together? 1, 2, 3, 4, 5, right? So these 2 boats together made 5 trips.
Yeah.
And each trips, the depreciation is 0.5. So together, the cumulative depreciation is 5 times half million, right?
Yeah. So 2.5.
2.5 million. So what's your net book value? Your net book value is 10 million, your cost, minus 2.5 cumulative depreciation. So your book value is 7.5 million, right?
Yeah.
And how much you sell it for? You sell it for 7 million. So you have a loss of 0.5 million.
Mm-hmm.
Yeah? Okay. So that's what has happened here. Loss on ships, loss on the boats, 0.5 million. Okay?
Yep.
So 10 minus 2 minus 1 minus 0.5.
Yeah.
So that's your net income, 6.5. Your opening return earnings is 8.5. Your ending return earnings, 15. Okay, 15 million. Okay, so let's take a look at the whole picture. Let's sum these columns up. Okay, revenue. Okay, each boat, there are 6 successful trips with each one $5 million sales. So that's 30. Okay. The operating expenses for the 6 successful trips is 6 million. Okay. The depreciation for the trips would be $500,000 times 6, 3, right? And the loss on ships. So you bought it. Okay, so for this one, let me think. So you bought it. Okay, so the total cost is 10 million, 15 million, right?
Yes.
The 3 trips, between the 3 trips, the total cost is 15 million. Okay. And you made how many trips? 7 trips, right? 1, 2, 3, 4, 5, 6, 7, right? So that's 3.5 cumulative depreciation, right?
Yeah.
So together, that's gonna be the net book value would be 11.5 million. Okay.
Yeah.
And you sold it for 7. No, that won't be right. 4.5. Okay, well, how did they get this $5 million here?
Isn't it? Aren't they just adding up the 4.5 that they lost from?
That's right. I'm just trying to help you to think in another way, right? So why you lost the shape for? Okay, so that's what happened. So 15, 12. Okay, so that's what happened. Okay, so you have $15 million cost, right?
Yeah.
And your trips, 6 trips, 1, 2, 3, 4, 5, 6, right? So that's why your cumulative depreciation is 3 million. Your net value is 12 million, right?
Yeah.
And you sold it for 7, right? So that's the difference. That's the 5 million. Okay. And your write-off of the prepaid expenses, that's just the 1 million on here, right?
Yeah.
Yeah. So now you put everything together, your net income is 15, right? So you start with a 0 beginning return earning, and you ended up with $15 million return earning. Okay.
Yeah.
So are we okay with the statement of income and return earnings?
Yes, we are.
Okay, awesome. So let's take a look at the balance sheet. Okay. For the balance sheet, the ending balance cash is 7. That's from this number, right? From the top here, from the first statement. Okay.
Yeah.
This 710, you can see it, right? Okay.
Yeah.
Prepaid expenses. So for year 1, okay. So these two trips is not finished yet, right? You prepaid these 2.
Yeah.
That's 2 million. Right. In year 2, you have prepaid. You prepaid this one.
Yep.
Right.
And voyage G.
Yeah, and this one comes back. So that one is gone, but you start this new one, right? And this one is still on the go, right? So you still have 2 million, right? So at year 2, you still have 2 trips on the go, right? So you have you prepaid 2, right?
Yeah.
Does that make sense?
Yeah.
So that's 2 million and 2 million. Okay. The shape at the cost at the end of this year, you have 3 boats, right? So the cost is 15, right?
Yeah.
And so then you have depreciation. Okay, only one came back. You recognize the depreciation, right? So the 0.5. Here is the 0.5, right? Sorry, 0.5. So now your total asset, add everything together, 23.5. Okay. Your contributed capital is 20 million. That's from the investor, right?
Yeah.
And return earnings, that's 3.5. That's from here, right? Did you see? Return earnings at the year end?
Yeah. Okay.
3.5. Okay,
Mm-hmm.
so that's how they balanced. Okay, so in year two, your cash balance is 10. That's from here, 10.
Mm-hmm.
Prepaid is 2. Okay, and
Yeah.
ship at cost. At the end of the year two, you only have 2 boats left. Each one cost 5. So your book value of the, sorry, your cost for the 2 boats is 10 million, right?
Yeah.
And you have one, you finished another, you finished these 2 boats, only this boat finished one trip, right?
Mm-hmm.
You should recognize a $500,000 depreciation, right?
Yeah.
So it's 0.5, okay? This 0.5 recognized in the beginning, in the first year is gone, right? Because you lost this boat. When you lost the boat, you lost both the cost and the cumulative depreciation.
Mm-hmm.
Okay, so for year two, right, for cumulative depreciation is only this part, right? Only this part.
Mm-hmm.
Okay, so that's $500,000. So your total asset is 21.5. 20 from the investor. Okay, you didn't pay back. The return earnings ending balance is 1.5. Okay, now let's take a look at year three. So for year three, the cash balance is 19. Okay,
Yep.
the cash balance is 19. Prepaid expense for year three, how many trips is on the go? Only one. Only this F, right?
Yeah.
That's what you prepaid. So you have 1 million prepaid, right?
Yeah.
The ship cost, you still have 2 boats, so that's 10 million, right?
Mm-hmm.
And at the end of year three, how many trips you have finished? Between the 2 boats, 1, 2, 3, right?
Oh, yeah.
By the end of year three, 1, B, E, C, right? So then you're gonna have a cumulative depreciation of 3 times 0.5. So that's 1.5, right?
Yeah.
Okay. And your total asset is 28.5 million. 20 from investor, 8.5 is from the return earning adding balance, which we have already figured out here, right?
Yeah.
Okay, now going to the year four. Okay, year four. The cash ending balance is 35. Okay,
Mm-hmm.
so for year four, at the end of year four, do we have any trip on the go?
No.
No, right? So there's no prepaid expenses. That's 0. Ship at the cost, you sold all the boats, right?
Yeah.
So there's no ship left, 0. No cumulative depreciation, 0. So at the end of the year four, you have $35 million cash, right?
Mm-hmm.
And out of this, $20 million is from the investor, right?
Yeah.
And return earnings is what you earned, right? What you have earned. That's the
Mm-hmm.
15 million, right?
Yeah.
Okay, because if you take a look at the middle statement, so net income you earned over the 4 years is 15, right?
Mm-hmm.
So basically, it's very easy. When you close the business, you have a bunch of cash left on hand, right?
Yeah.
So 20 millions from the original investor, and the 50 millions is what you earned over the 4 years. So in total, you have $35 million cash on hand.
Mm-hmm.
Okay, I think that's it. It's not too bad, right?
It's very long.
Yeah, but once you really understand, you think through the story, right? Is pretty clear, or are you still confused?
It is clear. I think I was just getting a bit confused towards the ending at the balance sheet when for like year two,
Yeah,
right? So how voyage B ended its voyage and it had recognized its prepaid.
yeah,
But then because at the end of year three, right? I thought it was only sorry, where is it? At the end of year three, only 2 ships came back.
yeah.
It's Voyage E and Voyage C, but you mentioned Voyage B, E, and C that came back.
In year 3, yeah, only EC came back.
Yeah, I'm just sorry. It was where is it? Year 3. I think is the accumulated depreciation.
Oh,
So
year 3 cumulative depreciation. Yeah.
yeah, because it's 1.5, right? So every depreciation is 500,000.
Yeah.
And so that's 0.5 times 3, which is 1.5. So
Yeah.
isn't it only supposed to be 1 million? Because at the end of year 3, there's only 2
Yeah,
ships
you are confused with two things, right? You are confused with two things. If I ask you depreciation expenses for year 3, that is 1.0 million.
Yeah.
Right? Depreciation expenses, because only E and G returned in year 3, right? So the depreciation expenses is 1 million. But here is the balance sheet. We are asking accumulative depreciation expenses. Cumulative means you have to recognize all the depreciations you have already recognized up to date, right? So by year 3, by the end of year 3, you have to recognize all the depreciation expenses for the account of accumulative depreciation. That's why there's a word called accumulative, right? It's from the beginning up to the date of the financial reporting. So in the balance sheet, right, your opening balance, year 3, right? Your opening balance is 0.5 million for cumulative depreciation.
Yeah.
And then you add the depreciation of 1 million for the year 3. So your ending balance should be 1.5.
Yeah.
So cumulative depreciation has an opening balance of 0.5 from B, right?
Yeah.
And for year 3, that balance increased by 1 million. So your ending balance should be 1.5.
Yeah.
Does that make sense? Okay.
One question, last one.
No problem.
Yeah. Okay. So from voyage A, is there no depreciation from over there?
Voyage A?
Yeah, in year 1. Since
Yeah.
it is
What happened is this boat is sunk, right?
Oh yeah, my bad. Sorry.
So
I keep thinking that they're different like ships.
Okay.
Yeah.
I understand you. Yeah, I understand. Yeah, it's kind of confusing. Yeah.
Yeah, but yeah,
this boat sunk, so that's why the cost and cumulative depreciation has been written off. That's why you recognize the loss, right? You recognize the big loss of 4.5, right? 4.5. Yeah.
Okay. It's clear now.
Awesome.
Thank you so much. Have you probably done the other questions with other students?
I have one question down. So you can just go to the Moodle website to watch the video. Yeah.
Okay.
Yeah. It's about the changes, accounting changes, right? There are 3 scenarios, and they ask you how the prior year and the current year, how the asset, return earnings, income is affected. So for that question, I already made a video.
Okay.
Yeah.
Thank you so much.
No problem. Hopefully this makes sense, right?
Yeah, it does.
Yeah. So you can always come back to rewatch this video if it doesn't. That's the benefit of online studying, right? You can always review your materials, right? So it's hard, So I'm glad we're recording all these videos. So.
Yeah.
Awesome. Okay, if you don't have any other questions, I will just close this meeting and I will prepare for our lectures. Okay.
Of course. All right. Thank you so much.
I will see you tonight. Yeah.
Yeah. All right.
Okay. Yeah. Okay. Yeah. Take care. Yeah.